Friends, this is Richard D. Wolff. Let me start bluntly. Donald Trump promised to make America great again. Instead, he helped turn your family car into the next financial time bomb. This is not a metaphor, it's a balance sheet. You were told the crisis of 2008 was a once in a lifetime disaster fixed by tough new rules and smarter regulation. The twist is this: the same financial tricks that blew up the housing market then are being run again now, not on your home, but on the vehicle in your driveway. Only this time, the scam is wearing a red cap, waving a flag, and calling itself freedom from regulation. We're not talking about a niche problem. As of late 2025, total US household debt has blasted past $18 trillion. Roughly 1.66 trillion of that is auto loan debt. That's not a number on a screen. That's millions of people chained to monthly payments they increasingly cannot afford just for the right to get to work. And here is the ugly irony. Trump built his political brand claiming he would save the forgotten men and women of America. Yet the economic machine that now preys most aggressively on those very people was supercharged by his crusade against financial regulation. Look at what has quietly changed since 2008. After the last crash, Congress passed rules meant to stop Wall Street from gambling with the economy. It wasn't perfect, but it was a start. Then came Trump. His administration, backed by Republican allies and bank lobbyists, spent 4 years drilling holes in those protections, raising thresholds, weakening oversight, and sending one loud message to Wall Street. Go ahead, the cop on the beat is off duty. Now take that political green light and combine it with a brutal economic reality. The average price of a new car in the United States has climbed over $50,000. Cars under 30,000 are becoming an endangered species. Automakers, chasing higher profit margins, abandoned the entry-level market and went all in on luxury trucks and SUVs. They didn't just leave working class America behind, they priced them out. Then another trick kicks in. Official inflation data, the Consumer Price Index, tells you vehicle prices are only rising modestly. But that's a statistical illusion. Government number crunchers adjust for quality. If your new car has more tech, more sensors, more mandatory features, they pretend part of the higher price doesn't count as inflation. On paper, things look under control. At the dealership, you're staring at a $50,000 price tag and wondering if you can afford to keep your job. That's where finance steps in with its favorite weapon: longer and longer loans. The old 5-year loan, boring. Now we see 7-year, 8-year, even 12-year auto loans. Stretch the term, shrink the monthly payment, and suddenly an impossible car looks affordable. $800 a month becomes $500. Crisis solved, right? No. Crisis disguised. Over the life of that extended loan, the total interest can run into the tens of thousands of dollars. You're paying a massive premium to slowly own a rapidly depreciating asset. A car loses 10% of its value the moment it rolls off the lot and keeps bleeding value every year. Your loan, meanwhile, barely moves. That's how you get the most poisonous phrase in consumer finance: negative equity. Here's the cinematic image I want you to hold. A tow truck at 3 a.m. idling under a flickering streetlight. A driver in a company jacket quietly winches up a minivan from a working class driveway. Inside the house, lights are off. Parents who just lost one shift at work are about to lose the only tool they had to get to the next one. That's not the market at work. That is policy made visible in steel and rubber. Because this isn't just about bad luck or personal responsibility. The architecture of this crisis was built piece by piece by politicians who told you regulation was the enemy. Under Trump, Wall Street lawyers were literally put in charge of the very agencies meant to police them. Capital requirements were relaxed for many banks. Supervisors were told to be business friendly. The message filtered down the food chain, pushed the risk out of sight and out of mind. But risk doesn't disappear, it mutates. Instead of regulated banks taking the loans directly, they poured money into a layer of shadow institutions, non depository finance companies that don't take deposits, don't have branches, and don't face the same scrutiny. These NDFIs gorged on warehouse lines of credit from the big banks, then sprayed that money across the auto market in the form of high interest loans, especially to subprime borrowers. Here is where the Trump era twist becomes lethal. While he was on stage bragging about stock market highs and cutting red tape, the real economy for working people was being rewired into a trap. Wages stayed flat, housing costs climbed, healthcare costs exploded. And in this squeeze, a car stopped being a consumer good and became a lifeline. Lenders knew this, so did the automakers, which made you the perfect captive customer. Subprime auto borrowers, people with damaged credit, unstable jobs, or thin financial histories were greeted not with caution, but with red carpet financing at 20% interest or more. Delinquency rates in this segment have surged to the highest levels in decades. Repossessions are projected in the millions, and each repossession isn't just a statistic. It's the moment when the myth of Trumpian prosperity meets the concrete reality of a missing car and a lost job. Remember the promise: you'll be winning so much, you'll get tired of winning. Now look at the data. More debt, longer loans, higher interest, more defaults, more families watching their vehicles vanish in the night while Wall Street packages their misery into yet another tradable product. This is not an accident. It is the logical outcome of a system that Trump proudly deregulated in the name of freedom, knowing full well that the only ones truly free in that system are the banks, the hedge funds, and the CEOs cashing out before the crash. The rest of America is left holding the keys to a car they can't sell, can't afford, and can't live without. The engine of this crisis isn't just under the hood of your vehicle, it's in the laws, the loopholes, and the deliberate blindness of an administration that weaponized deregulation against its own people. And as with any overloaded engine, you can already smell the smoke before you see the flames. Those flames are already licking at the walls of the financial system. You just don't see them on the evening news because they don't show you the wiring behind the drywall. On the surface, it looks simple. Borrower can't pay, car gets repossessed, lender takes a hit. Painful, but local, contained. That's the story Trump world wants you to believe. Individual failure, bad budgeting, nothing systemic, nothing that could possibly stain the MAGA fantasy of the greatest economy ever. But once you follow the money upstream, the picture flips. The lender on your paperwork often isn't the one really holding the risk. Behind that name is a chain. At one end, a dealership desperate to move overpriced vehicles. At the other, a major bank with a marble lobby and a Trump era tax cut fattening its profits. In between sits the shadow lender, the NDFI, acting like a financial laundromat for risk. Here's how it works in practice. A big bank extends a huge warehouse credit line to an NDFI, hundreds of millions of dollars. That NDFI then sprays money across the country, buying or originating subprime auto loans from dealers. In return, it pledges the stream of monthly payments as collateral back to the bank. The bank, thanks to post 2008 rules weakened under Trump, gets to label its exposure as a relatively safe corporate loan instead of a pile of junk subprime paper. On the books, it looks clean. In reality, it's toxic. And Trump's deregulation crusade helped build the pipes that move that toxicity around. Because the NDFI model only works if it can reach ever deeper into desperation. Its cost of funds is high, 8, 9, sometimes more percent interest owed back to the big bank. To survive, it has to lend at 20, 22, 25% to the most vulnerable borrowers. That is not a mistaken design. That is the design. And when the economy tightens, when wages trail inflation, when rents eat half a paycheck, who breaks first? Not the bank, not the CEO, the subprime borrower. The family, one emergency away from disaster. Missed payments start to pile up. Cash coming in slows. Cash going out to the bank does not. That is when the NDFI panics. This is where the script becomes disturbingly familiar to anyone who lived through 2008 under pressure. Some of these shadow lenders reach for fraud like a drowning man reaches for a floating plank. Double pledging, misstating collateral, using the same rotten pool of loans to secure multiple lines of credit from different banks. It's the financial equivalent of selling the same car 3 times to 3 different buyers and hoping they never compare notes. And yet, the big banks act shocked when the scheme collapses. They claim they were misled. They stress they did their due diligence. But in a deregulated environment, they helped design under a president who mocked regulation as job killing. It is hard to believe they didn't understand exactly what kind of game they were funding. The Trump era legacy isn't just slogans and rallies. It is an entire political climate where regulators are told to back off, watchdogs are defanged, and any attempt to tighten rules is denounced as socialism. That climate is the oxygen feeding this fire. Then comes the Wall Street magic trick, securitization. The NDFIs don't simply sit on their loan books, they slice them into complex securities. Thousands of auto loans bundled into asset-backed bonds, tranches stacked like floors in a building. Senior at the top, equity at the bottom. Ratings agencies stamp letters on the facade. AAA, AA, safe, stable, investment grade. Inside, the wiring is frayed. The models assume defaults are scattered, random, uncorrelated, a missed payment here, another there. Nothing that could bring the whole structure down. But that assumption collapses when you remember what Trump's economic miracle really was: a sugar high of tax cuts for corporations and the wealthy, with no serious fix for stagnant wages, unaffordable housing, or runaway health care. In that kind of economy, people don't default one by one, they default together. When inflation bites, when student loans restart, when landlords hike rent, the same squeezed workers start dropping their car payments at the same time. Suddenly, those senior tranches aren't so safe. Losses that were supposed to be absorbed at the bottom of the structure start punching through the middle floors and rattling the top. Picture a skyscraper on a fault line. Every tremor from the real economy, a layoff, a rent spike, a medical bill, sends a shock up through that tower of auto loan securities. Windows crack, floors buckle. The lobby, the marble, the executive offices, none of it is as stable as it looks from the street. This is the part no one in Trump's orbit wants to talk about. They will blame immigrants. They will blame irresponsible borrowers. They will even blame the Fed. But they will not admit the obvious. When you dismantle regulation, glorify debt fueled consumption, and hand Wall Street the keys, you are not making the system stronger. You are turning the entire economy into one giant used car lot where everything gleams under the lights and rots the moment you drive it home. From the outside, the rot still looks manageable. A few lenders collapsing, a few banks tightening credit, a few lots overflowing with unsold trucks and SUVs. Trump loyalists spin it as market adjustment, a temporary cooling off. But anyone who has studied financial plumbing knows a simple rule: when pressure builds in one pipe, it spreads through the whole system. And that pressure is now everywhere. Start with the dealerships. They don't own their inventory outright, they finance it through floor plan loans. Every day a car sits unsold, interest ticks up. A Jaguar F Pace can sit for a year, an Audi A6 nearly as long. Even the hyped Tesla Cybertruck, Trump's favorite symbol of American greatness, is missing its sales targets by as much as 90%, leaving lots stuffed with unsold stainless steel monuments to corporate overconfidence. These vehicles aren't assets anymore. They're liabilities with headlights. When credit tightens, fewer buyers get approved. Even families with decent credit scores are suddenly told no. With no buyers, the metal piles up. With the metal piling up, dealers bleed cash. When they bleed too long, they fail. And every dealership failure triggers another round of loan defaults upstream. It's a death spiral carved directly into the business model. None of this is accidental. This is what happens when 4 years of Trump era deregulation collide with a massively financialized consumer economy. Every weak point becomes a breaking point. Then comes the regional banking sector, the part of the system closest to ordinary Americans. These banks are already scrambling to merge, consolidate, and bulk up because they see the incoming wave: Huntington absorbing Cadence, First Foundation folding into First Sunday. These aren't growth moves, they're bunker moves, the financial equivalent of boarding up windows before a storm makes landfall. But the most dangerous illusion right now is the idea that the auto loan crisis is small compared to 2008. Yes, the total auto debt, $1.66 trillion, is less than the nearly $10 trillion in housing debt that detonated the global system. But that comparison is misleading. The real danger isn't the size of the pile, it's how deeply the pile is wired into the machinery of finance. Trump's deregulation legacy ensured that the exact same shadow infrastructure from 2008 warehouse lending, securitized debt, arbitraged risk models remained alive and untouched. You don't need a bigger explosive when you've built a tighter room. You just need a spark. And that spark is already flying. Delinquencies among subprime borrowers have hit the highest levels since the mid 1992. More than 3 million repossessions are expected this year. Millions of people will lose not a luxury, but a lifeline. In a country with almost no public transit, losing your car doesn't mean inconvenience. It means losing your job, losing your income, losing your stability. A society this dependent on vehicles cannot survive a mass seizure of transportation without deeper fracture. And while working families are pushed into crisis, Wall Street is already gaming out its exit strategy. If the defaults pile too fast, if the securities start cracking, if the contagion jumps from shadow lenders to regulated banks, the pressure will rise on the Federal Reserve to intervene. That means a bailout. Not the word they'll use. Of course, they'll call it market stabilization or liquidity support. But the mechanics are the same. The Fed prints money to buy toxic debt and rescue the institutions that engineered the disaster. The last time this happened, Trump blamed the Fed for punishing his economy, even as he championed the very deregulation that let Wall Street gamble again. If the Fed steps in next time, it won't be to save borrowers losing their cars. It won't be to save dealers collapsing under inventory. It won't be to save workers. It will be to save the same financial class Trump empowered banks, funds, executives, while inflation and instability get pushed onto the public. The two paths ahead are equally brutal. Let the market purge itself, and you get a catastrophic collapse in used car prices, a wave of bankruptcies, and millions stranded without transportation. Step in with a bailout, and you inflate away public purchasing power, reward corporate recklessness, and hardwire moral hazard into the system yet again. Because beneath every chart and statistic lies a simple truth. The crisis wasn't created by borrowers. It was built by design through deregulation, predatory lending, and a political ideology that treats working Americans as collateral for corporate profit. That ideology reached its peak under Trump, wrapped in slogans, rallies, and a promise of greatness that hid a financial time bomb under the nation's most ordinary object, the family car. And now that bomb is detonating in real time with sparks hitting every corner of the economy. The question isn't whether the system will absorb the shock. It's how much ordinary Americans will be forced to sacrifice before the architects of this disaster admit that the engine has already seized, the smoke is pouring out, and the road ahead is no longer safe to drive.